Thanks for joining us for the third episode of our Fundraising Podcast. Today, we're going to be taking a deeper dive into mergers and acquisitions. That's right, M&A. Now, considering options for founders, investors, this is something that we want to explore and provide further insight into. Now, before we get started, I want to remind you all, don't forget to subscribe, to like, if you like our content, and most importantly, to click the notification button so you can be updated when we release new episodes. And by all means, share this content with anyone that you feel will benefit from it. Now, today we are going to be joined by the CEO of Area Advisors, which is Brad Furber. Brad, how's it going?
Pretty good. How are you?
I'm good, thanks, Brad. I'm good. Mergers and acquisitions. This seems like it's a credible option, considering the challenges of fundraising today. What can you tell us, Brad?
Well, yeah. So again, thanks for inviting me. I think the big picture here would be to look at our client base and people who tend to view our content. They tend to be early stage and emerging growth type folks. Obviously, one of the things when you start a business is you want to, scale it, take it public, that kind of stuff, achieve the dream. For a lot of companies, for a variety of reasons, they may need to consider other ways of providing liquidity. And the most common, obviously, would be mergers and acquisitions. So I've got a few stats, just to put us in context. Do you want me to go over some of the big picture stats? Or?
Absolutely. So it'll be really good to just know where we are, what's happened last year, what we're going to be facing this year when it comes to mergers and acquisitions. But also, I would like to ask you some questions about this just from the perspective of a startup founder or a co-founder. By all means, Brad, let's get started.
Okay, well, let me just put it in context. So we're doing this podcast February 7th, and the deal data for 2022 is largely known at this point. 2022, of course, was not a good year in many respects for a lot of different reasons. But a few of the key stats that I wanted to throw on the table is in terms of global M&A volume year over year, it dropped precipitously from 2021. Now, 2021 was a record year. 2022 fell 36% year over year, still healthy, to $2.9 trillion. Now, that's the big picture global M&A. The other thing that drives this, I've mentioned IPOs, the total global equity issuance in 2022 fell 67% year over year versus 2021. So not only did the M&A exit window close compared to 2021, the ability to raise new capital in the public markets fell precipitously. The number of initial public offerings actually fell by 71%. So the IPO window, while it's not completely shut, it's definitely, it's not the heyday of 2021 or even Q1 2022. And then lastly, I think the big picture, at least the S&P 500, which is a benchmark, of the 500 best performing U.S. companies, that also fell in 2022 by 18%, which was the biggest decline since the great financial crisis of 2008, 2009. So the big picture is that both the IPO market and the M&A market in 2022 was not great, but nevertheless, it's still open. And so businesses, just because the market dynamics aren't as favorable as they were, say, in 2021, it doesn't mean that you can avoid the reality of, what are you going to do if you have a company and you need to try and seek an exit. And that's what we're going to talk about is mergers and acquisitions more than say, IPOs.
So, okay, if I'm an entrepreneur and, I've got this startup and, let's say I've raised a couple of rounds and we're in this climate now, how would I even go about getting started for the acquisition process?
Companies that are successful at raising capital in the modern era probably already have a deal room, a data room, right? Because that was probably something they had to do in order to successfully raise financing through, let's say, the seed or Series A or whatever. Series B round. So they have their, quote, house in order. They should have their house in order. Then the question becomes, how do you position yourself to find potential? I guess it's a question of what is it that you're really looking for? Nobody, starts a business necessarily with the intention of selling it. I mean, at least a lot of investors, they don't want to hear that. They want to hear, oh yeah, I'm building this for the long term. I'm going to go all the way. But the reality is at some point along the way, it may be that the company has built something that is valuable, but it might be more valuable in the hands of different owners. And so how do you, without putting up a for sale sign, hey, I'm for sale? Because keep in mind, if you're running a company and the employees or the competitors or the customers find out that you're for sale, you might run into problems, i.e. attracting and retaining employees. You might run into problems because competitors find out and they start telling potential customers that, hey, those guys are going to sell out. You should go with us. And customers themselves are like, well, geez, I do a deal with you now, but then I'm going to end up with somebody else in 18 months. You typically don't want to advertise that you're for sale. How do you structure that? There's a lot of different ways. One is you hire an investment bank or a business broker, depending on the size of the company. Now, keep in mind, the middle market M&A is a different segment than the bulge bracket stuff. So middle market M&A, let's just define that as transaction value somewhere between 10 million, say 500 million. Traditionally, 10 million to 250, thereabouts. Because the reason is the kinds of people who work on those transactions are different than the kinds of people that work on the big transactions. And that's just economics, because M&A brokers typically get a percentage of the transaction volume. The big bulge bracket firms tend to dominate in the bigger transactions, and then the M&A, business broker / M&A advisor do a better job with the smaller transactions because they're typically staffed a little leaner, and it's a different process. But bottom line is you need to have a story, and preferably you've got your financial statements in good order. And hopefully your financial statements are looking good, not bad, right? Because when somebody's looking to buy the company, I guess there's different reasons why a buyer might buy the company. A financial buyer is really just looking to acquire the business, maybe recapitalize it, perhaps change over management, bring in a different team. But essentially, they're going to be looking at EBITDA, earnings before income tax and depreciation and amortization. So am I going to, do you have some more questions there before I go into that deeper?
Yeah, I mean, so it sounds like for a founder who's considering selling his startup, there are some things that must be considered, some important things, okay? And I'd like you to touch on, what are the key things to consider before going down this road, of selling your startup? What would you say the key things are?
Well, the key thing is, are you desperate to sell because you're going to run out of money, in which case, essentially, you have a bit of a fire sale going on? Or are you thinking, in order to actually fully realize the potential of the business, I actually need a company like a strategic who has greater resources, maybe greater distribution, complementary products or services, and they can, assuming you can't raise the kind of capital that you think you'd need to do it on your own, you would bolt on to somebody else's platform. So those are called bolt-on acquisitions. And it can be a great thing, for the company that's built something that's pretty cool. If you add that tool into the greater tool set, maybe it's just a feature. It could be a crucial feature to somebody else. Yeah.
Okay. So if as a founder, I've decided to go down this road of, okay, I can't raise the money that I need for whatever reason it is, I'm now considering selling this company. Is the preparation much different to preparing for an investor for, let's say, Series A round?
It's very similar. I would say it's similar. And in fact, there are companies that sometimes go to market, for example, try to do an IPO and instead get acquired. So they've done the work to say, okay, look, this is what we can do as a standalone company. But somebody else might come in and say, oh, well, that's interesting. I mean, the classic example of this is a couple of ones that everyone's aware of are Instagram, the acquisition of Instagram by Facebook prior to the Facebook IPO. So keep in mind that that's turned out to be a pretty good acquisition at the time, which was I think around 2012. I remember I was actually in the Valley and talking to some people that were in that deal. The company is at the time of the acquisition, as I recall, had 0 revenue and 12 employees or something like that. But they had a mobile strategy. They were growing rapidly. Facebook didn't have a mobile strategy at that point. They were concerned that Instagram, had the potential to do what Instagram ultimately did, which was arguably become more valuable than Facebook itself. Would they have been able to do it as a standalone company? I don't know. With the full resources and the talent and the reach that Facebook had, they obviously were able to become what it is today, which maybe now is already peaked, according to, my daughter. It's like, oh yeah, Instagram so yesterday. Another example of this, again, that everyone's heard of is YouTube. So, YouTube, I think that was around 2006. Could YouTube have done what it has done if it was a standalone company? Who knows? All we do know is that Google bought it, and with Google's resources, they were able to invest heavily and ultimately come up with a business model. I guess my point here is you're a startup, you've got something that's interesting, doesn't matter if you're a technology company or something else. Do you really have the ability to scale it? Do you have the sales team to scale it? Maybe somebody else already has the global distribution, global sales, and this is just another thing they pop in and they can maybe rebrand it or whatever. There's financial buyers. Financial buyers are going to look at what is your EBITDA, what are the key financial measures, and they'll try to typically use some kind of leverage to help, buy the business and hold you accountable based on these EBITDA performances. Those are called financial buyers. They tend not to pay as much. Strategic buyers are the ones like I just mentioned. They just see a big strategic opportunity, and those are the ones who tend to overpay, at least overpay based on any financial metric. Turns out that Instagram purchased a company with no revenue for $1 billion or whatever. Seems kind of high, but in retrospect, maybe not.
So do you feel that strategic buyers are way more appealing for a startup founder than a financial buyer? Is it?
Oh, yeah. If you can sell to a strategic buyer, you're always going to get more money than you would to a financial buyer, for sure.
So how can a founder negotiate a good deal, whether it's a financial buyer or a strategic buyer? How do they go about,
there's an old saying in the M&A business that one buyer is no buyer. If you only have one bidder, you're not going to get the best price. So in order to do this, you need to run a process so that hopefully you get at least 2, preferably 3 or 4 bidders. It's just like an auction. If you're the only one at the auction, you walk out with the good at the lowest price. If there's more people at the auction, people tend to, up the price and you get a better. So that's what you try to do, is you're trying to run a process where you can get several bidders to come to the table at the same time. That's how you do it.
I mean, how does this process even impact, like the stakeholders, your existing stakeholders of the business?
Well, it gets back again to this secrecy issue. You don't want everyone to know that you're trying to sell the company for the reasons I already articulated. You might spook your existing team members, right? They'll be looking for a new job. You might spook your customers. And if your competitors get wind of it, typically they may be able to use that information to win customers, maybe steal your customers, or just win new mandates. So you don't typically want this information to be publicly available. However, how do you create a process where multiple parties know that this is an opportunity? So the way you typically do it is you hire a firm to be able to market the opportunity in a confidential way.
Wow, I can imagine how challenging that would be for an owner or a founder of a company that has to go through this process, but yet manage the team. And I mean, obviously the stakeholders will have to be informed, but you wouldn't want to spook your existing team, the operation, and definitely not let your competitors find out. How do they do it? I mean, when there is an acquisition opportunity happening, this news tends to come out sometimes before the acquisition, doesn't it?
Well, if it's a public company, you could potentially have a real problem. It's called insider trading. So with a private company, you don't have the insider trading issue, at least not on the sell side. Depending on the size of the deal, potentially you do on the buy side. But you just got to work with people that know what they're doing so that you can keep everything confidential. Interestingly, back in 1996, I co-invented a patent that was issued to do precisely this. We were creating a way to use public networks, i.e. the internet, to do confidential, anonymous negotiation of M&A transactions. That's what it was. The patent was issued. I won't get into all the ups and downs. That was during the .com era, and but the problem still exists, and so there are some marketplaces where you can buy or sell businesses. I mean, it really you got it. I mean, there's no one size fits all. I mean, it depends. If it's like an internet-based business, there's a whole bunch of those marketplaces that exist, and no big deal. If it's a bigger type of business, in my experience, you can try and run the process yourself, but I think most people find that it's a lot of work, and they end up hiring M&A advisory firms to assist.
Yeah, I remember in some of my conversations with founders, and we talk about their strategic plan for the business, and they always mention the exit, and some have an exit plan in like 10 years of running a business, right? They plan to exit the business in 10 years, and almost the majority of them are focused on that strategic buyout, right? Because we read so many stories about these firms that have been bought out by the giant corporations, right? And like you said, it's a lot more money in the deal. So in that regards, would a founder be focused on contacting these organizations, the brokers and the dealers that deal in M&A to get the attention of the larger companies, larger corporations, or is it a case where the larger corporations are constantly looking out for smaller companies to buy out?
Yeah, so most companies have what's called a corporate development function, whose job it is to come up with investment theses and then scan the landscape to find attractive acquisition targets. I would say most public companies for sure have that. And so they're always looking for opportunities, right? The private equity firms, that's what they do. And so the question is, if you're a private equity firm, I mean, what you're telling your limited partners is, hey, we have proprietary deal flow, we have special expertise and access to deals, and that's why, if you give us the money, you're also going to give us, say, 2 and 20 or whatever it is, 2% management fee for assets under management or committed, and 20% of the carry. That's a standard model. Warren Buffett, recently was criticizing it as not a great model for the investors, but be that as it may, that is the model. And so you have to do something to earn your fee, right? And so you have a team of people that are scouring the market looking for opportunities. Now, do you just sit back and answer? Are you just responding to, for example, confidential memorandum that are being circulated by the M&A brokerage firms? Okay, so the M&A firm, let's say that you do have an advisor, they put together the book, they come up with the prospect list, they mail, some kind of a teaser. If you're interested, then you have to respond, say, yeah, I'm interested. Then they give you access to a little bit more information. And what the M&A advisory firm is trying to do is, like I said, go through the funnel so that there is a date, ideally, where all parties have to give us your best bid on or before X. And that's, in a perfect world, that's how it works from the sell side. On the buy side, do you just sit around and wait and respond to these auctions, or do you take initiative because you have a theme, and now you're out looking for companies that fit your theme. And so even though the company may not, in fact, be looking to sell, you go in with an unsolicited proposal, say, hey, we know who you are, we like what you're doing, we want to have a discussion with you. And it may be that the entrepreneur wasn't even thinking, or the management team wasn't thinking of selling, but this opportunity comes up and they're like, oh, wow, well, that's interesting. And keep in mind, in that case, there probably isn't a second buyer. So for the buy side here, it's a better deal because you're not competing with anyone. Right. Because trust me, this creating a market where you've got competing bids, it's not that easy. And you don't do it in 2 weeks.
That sounds to me like that's probably a much better case scenario for the founder to be approached by a company that...
Not necessarily, because they've approached you. They know more about your business, how they would be able to monetize it than you do. So it's not necessarily true that an unsolicited proposal would generate a higher exit value than a process.
Well, if we're looking at the current climate, so imagine this is the scenario. You've raised, let's say, pre-seed and a seed round before. You're in the thick of it. There's been all these changes in the market, like you stated, the stats earlier on, and you're now considering what your options are, because it's very, very difficult to raise money. Although you've succeeded before, it's much more challenging to do now. If you get approached by a corporation that wants to acquire your company, that might be a good option for you, right? And in fact, Brad, maybe you can shed some light on this. If I was in that situation, maybe I wouldn't know what the best option is. Maybe I would want to continue fighting because I have been successful in raising money before, and maybe this situation that the climate won't necessarily apply to me if I just continue to persevere. That's typically the mindset of a founder or a CEO. You just keep going, right? So what would be the signs for me to really consider an acquisition with another company?
It becomes a business judgment. Do you and your team still have the same motivation and confidence that you can fight the good fight for the next 3 to 5 years or whatever it is? Or all things considered, do you think actually maybe now is a good time to get out? And so it's a business judgment. A lot of times it has to do with people's age, their desire to do something different. Sometimes people get bored. Like, oh, God, I've been doing this for 15 years. I used to love it. My spouse is retired now, and maybe we want to buy a sailboat. I mean, I know that sounds crazy, but those actually are not uncommon situations. Maybe you've been in, honestly, sometimes these companies, there's a lot of companies out there. Maybe you're a third generation, or maybe you inherited the business from, your parents, and you're like, I thought I wanted to do this, but actually I don't. And if I could just get liquid and, all the employees can be treated fairly, I'd be happy. So there's a lot of different reasons why people want to sell.
Yeah, I suppose it would be a very tough decision for a founder to make.
Yeah, it is. It is. And I would say one of the other things, just for what it's worth, having been involved in a few of these, is the closer you get to closing, the more committed you are to doing the deal. And so sometimes if you don't really have an alternative waiting in the wings, sometimes the deal gets renegotiated towards the end. And, it's your classic, what's your next best alternative? If you've already bought the sailboat and started to make plans to go to the Mediterranean or whatever your plan is, and all of a sudden somebody comes in and says, actually, we're going to make a few changes. Do you really have the ability to walk away? mentally and or financially. So just those are things to be careful. Is it's never over till it's over, right? And so you got to be prepared to run that business all the way through. A lot of times there's also an earn-out. You know what an earn-out is? It's instead of paying 100 cents on the dollar, they say, okay, assuming the company continues to perform post-acquisition, then you can earn an additional amount. That's pretty common, which means you got to stick around to help deliver the business. I won't get into all the ins and outs of the earn-outs and the pros and cons of doing that, but it's fairly common. So
you mentioned earlier that the performance of the S&P hasn't been this drastic since the 2008 right situation. And do you feel like a lot of startups that are unable to raise capital this year will be acquired, or will they just go out of business?
I don't have a crystal ball, but I think the current market reminds me a bit of the post-dot-com market. Why do I say that? There's a lot of so-called dry powder, but there's also, if you just look at the statistics, the amount of capital that's available relative to the amount of capital that is being requested. Well, the last couple of quarters, basically, the people with the money are not as free about investing it as the demand. So the demand is greater than the supply. I don't know if I'm saying this correctly, but basically, although this dry powder exists, there's a reluctance to deploy it fully, in part because of fear about what's going to happen. So it's right now in February 2023, it's an investor-friendly market. It's not founder-friendly. It's just the balance of power right now is on the capital side. So what will that mean? I do think, just like what we saw in post.com, there's probably a lot of companies that are going to run out of money, and so they're going to be forced to look for an exit, and that exit may not be on the kind of terms that they had originally dreamed about. And so getting ahead of this so that you don't get left with no options, i.e. you hit the wall literally and have to shut down, lay people off, quietly sell the assets and call it a victory when in fact it was just a fire sale. Acqui-hires, that's where buyers take a look at the assembly of your team. A lot of times, the engineers are the most valuable, and they say, hey, we'll do a transaction where we effectively are acquiring the talent, but not really the business or the technology. Those tend to work out fine for those who get hired, but not so well for those who don't. So those are the big picture. I do think that what we're going to see is in 2023, something like what we saw back in 2002, 2003.
It does sound like it's going to be a tough year for a lot of founders. And I would like to think that as a founder, I would always want to fight to keep my baby, your business, right? You want to keep your team, you want to keep the business going and delivering. But if one is to be proactive based on, the insights that you shared with us, when would one take action? Is it when you have 6 months runway left? Is it when perhaps a deal that you had in the pipeline hasn't come through? I mean, when should you be proactive about looking at your options for M&A?
Well, personally, if you have less than 6 months runway, you've got a problem. Because it honestly, it takes 3 to 6 months to raise capital. M&A transactions can take even longer.
Oh,
Um, Frequently they do, particularly if you're dealing with financial buyers. If you're dealing with a strategic buyer, they can usually move quickly, and they're not basing their decision based on a lot of due diligence of the business. They're basing it on the due diligence of what they perceive to be perhaps the value of the intellectual property, for example. So yeah, I would say if I was looking to raise capital in the current market, I would probably also have sort of this is what I would start exploring potential sale of the company options as well, or even recapitalization of the company. Yeah, I would be anyone who has less than say 12 to 18 months of capital runway is at risk.
but what if it's a startup that I know you mentioned earlier about some of these strategic buyers have acquired companies that are pre-revenue, right? So what if you're running a startup now that is pre-revenue and you're wondering whether it would be of value at the stage? Do they still have a shot?
Yeah, if it's good. I mean, there's lots of companies that they built something and it's super cool, and somebody else may have capital and distribution, and they can essentially either take that and incorporate it into their existing suite, or maybe just take it and say, hey, we'll capitalize the company, but we'll be able to, like distribute it because we already have an installed base of, some of these big tech companies. That's the problem with trying to compete, frankly, with Google or Facebook. The big tech is they have free distribution. There's some antitrust, anti-competitive issues there, but if they can take your product that you have to sell, right, and they can give it away for free. I mean, right now everybody's in love with Chat GPT, and now Google's got their, whatever they're calling it, the Bard, and I think Baidu, the big Chinese company, they've got one, the Ernie or something, right? So what if you're one of these people that's building a Chat GPT like app?
Yeah.
Well, how many strategic buyers are there? Not very many. That could be a problem. So you're in a hot area, everybody's lapping it up right now, but how many strategic buyers are there?
And it's a good point actually, because OpenAI, ChatGPTs, is free. Anyone can subscribe for free. You don't have to pay to use that service.
Yeah, but I think who knows what they're going to do to it. I thought in order to get the enhanced features, you got to pay a monthly subscription. I mean, who knows with all the how does Microsoft monetize ChatGPT? How will Google monetize it? Google, they provide a lot of really great products for free. But and I know that if somebody's giving you the product for free, then you're the product, right?
Exactly.
So
I'll round up with asking for startups that have a shorter runway, 6 months, maybe 12 months. What could they be doing to prepare themselves to go to their
Okay. Sure.
Okay, brilliant. Wow. So Brad, what do you think startups that are in a position where they have 6 months runway, potentially 12 months runway, what could they actually do to make themselves more attractive for an acquisition?
Well, first of all, I think they need to do some market research to figure out who would be able to take what they have and commercialize it. So let's just say, for example, you've got something and you've proven it, you've got product market fit in a particular market, but in order to expand, let's just say you want to go international. Maybe, you've proven that it works in, I don't know, Spain. Okay, great. That's great. Spain's a big country. It's a nice country. Do you have the resources to expand into, say, Germany or UK or the United States? If the answer is no, then say, okay, well, then how are we going to raise enough capital to be able to do it ourselves? Either through cash flow from operations or debt or equity, or B, could you partner with somebody? I think you need to be able to answer those questions. Let's say you're a medical technology company. It's what you're doing is super cool. You've done some clinical trials. The data is positive. But you're still just a skeletal team of basically scientists and maybe a little bit of regulatory. Once you get, to a point where maybe you're going to start to manufacture and distribute, maybe that's the ideal time to sell. Because then you don't have to build that capability. You just need to deliver the innovation, and then they take it and say, oh, well, we'll take it from here. Thanks. You guys did the hard early stage work. Now we're going to take it and commercialize it. So there's lots of, big pharma, medical technology companies that are constantly scouring the earth for these, brilliant opportunities and ideas that they can take and commercialize.
So when I say you've been around, have you been involved in these deals, or you've... Yeah. Okay.
I'm a nature.
Okay, brilliant. Right, Brad, so the fact that you've been in this industry for a long time, and you've been around hundreds of, M&A transactions, perhaps you can share with us some war stories, examples of acquisitions that have been a good deal, and perhaps some acquisitions that haven't quite worked out in the favor of the founder.
Yeah, okay. I'm not going to name any names, of course, but I've seen all sorts of deals. There's a deal that I was involved with as both an advisor and fortunately also as an investor, that I thought that worked out really well for all parties. And this was a company that had an ambitious vision, hired a group of engineers to build the first version of the product, and for a variety of reasons, they couldn't quite get it done. Raised some capital, a few $1 million from investors, but not VCs. I mean, people that have been involved in venture capital, but this was individual. And, there was some discomfort in the early years because they effectively had to get rid of the original, quote, founder engineers, which is never, pleasant. But the group basically stuck to their guns, continued to innovate and develop it, and build what turned out to be a very nice business in the United States. And it was making a lot of money, which was great. But this particular business, I'm not going to get into the exact industry, but they wanted to expand internationally, and for their solution to work, they were going to need to make substantial investments in both the technology to make it work in other countries and also the sales side of it. And as they thought about, okay, do we go back to the well and do a big Series A $50-100 million financing and try to build it ourselves? Or B, do we just try and find a strategic acquirer who can take what we've already built and bolt it into what they're doing? And in that case, they ended up hiring a firm to shop it quietly. They didn't want anyone to know that this was happening. And in the end, they did bring several competing bidders to the table, some of whom were financial. And so they had a model based on EBITDA, a multiple of EBITDA, and others were more strategic. And not surprisingly, they were willing to pay quite a bit more. And the company was acquired. All of the founders, because they had shares that had vested persona to a reverse vesting schedule. Got rich, even though they hadn't worked for the company for 3-4 years. All of the investors got a very attractive, return on investment, 20x or more return. And the employees got a good deal too, because the new company is a publicly traded company, lots of opportunities. So not only could you grow within the business, you could also perhaps transfer to other parts of the company. So it was just a win all the way around for everyone. And it's funny how a big win like that heals whatever the wounds were from the early years, because there were some hurt feelings. There always is. But nobody is like crying now, I can assure you. So that was a win. It was a good win. One of the worst ones, frankly, that I've seen was the situation where this founder entrepreneur had just invested blood, sweat, and tears over many, many, many years. Unfortunately, he exercised his stock options thinking that would be favorable from a tax perspective, and he did so with a promissory note, didn't pay cash. And as long as, he was CEO and on the board, nobody was, worried about it, right? But then as the company got closer and closer to hitting the wall, new investors were coming in, and ultimately they did, I don't know if it was a Series D or a Series Z, but it was, one of these deals where the last money in was pretty punitive. They had some kind of 2 or 3x liquidation preference on the money they invested. Plus they had some rights to force everyone to sell the company if they said so. And so they did. They ended up exercising that right to sell the company, and the buyer came in, and from a mathematical perspective, basically the last money in was going to get 100 cents on the dollar. And all the early angel and VCs were going to get zipped. I won't get into all the details. They ended up negotiating some kind of small payout to some of the other investors just so there would be no lawsuits. But the one guy who really got hurt in the process was the founding CEO, because the debt was a pretty big number, and even if the company just forgave the debt, that's a taxable event. So he ended up losing a lot of money. So not only did he not make any money, he ended up losing a lot of money. And it was just poor planning. He lost control. I mean, that was bad. So I guess what I want to say is pay attention to the details, because at some point, even though you're currently the CEO, there could come a day when you're not. And will the next person or the person after that either be required under law, or be just kind of be a jerk and treat you in a poor way? I mean, we see this all the time in politics, right? One president does one thing, the next guy gets elected, and he just does everything he can to make things difficult on his predecessor or her predecessor. It happens in companies too. And so you got to be, I guess what I'm saying is, the details always matter, and you should make sure that you haven't put yourself in a position where something could kind of come back to haunt you.
It's so sad. You put your blood, sweat, and tears into a company, and then you're not in a position to sell the company, but then you owe money. You end up in debt as a result of it. How could the second story of the CEO founder, how could he have prevented that? Did he not have like accountants or good, counsel around him? How'd you end up in a situation like that?
Look, I don't want to point fingers, but yeah, I think this person didn't pay attention to the details and didn't really evaluate the full potential of the downside because he had drank the Kool-Aid on the upside. I mean, this company at one time was like a lot of companies in 1999, looking at a different world. It's not dissimilar to companies who raised money in 2021. So this same nightmare scenario, I predict history will repeat itself, unfortunately. And I bet you there's a bunch of people right now, maybe some who are going to listen to the podcast, who are like, holy crap, I got to fix this problem. And they should. Sooner the better.
Well, that's great advice. I think if anything, this is what we're trying to do with the podcast. We're raising awareness, we're providing insights. So if there is any founder that's watching this that may be really considering their options at the moment, they could start to take action, be proactive.
Yeah, you want to do it when you still, when you have time. If you wait until the end and you have no leverage, then a lot of times your ability to protect yourself or make the changes in a way that is full, with knowledge and consent of all parties. I mean, you want to do this in sunlight. You don't want to do this in a back room, but you want to do it in a rational and a timely basis. So, getting back again. So in the current market, if you're a company and you're either trying to raise money to achieve the dream, and or B, saying, well, what's my next best alternative? I would, in the back of your mind, even if you don't tell anyone, kind of have a plan B, and start to work on that list of who else out there, whether it's a competitor or an adjacent player that could fold this in, who would those, and start to develop some relationships. People frequently want to hide what they're doing. I don't want to tell anyone because they might steal my idea. Okay. You don't want to, give away the farm. But on the flip side, you probably do want to start developing relationships with folks that could potentially take what you've built and make it better or bigger, right? Nobody's irreplaceable. I don't think. Not even Elon Musk. And he's about as close as they get right now, I think. Or maybe some people would like to replace him. But, people like that are very rare, let's be honest. For most people, the graveyard is full of indispensable people.
No, absolutely. And I think it does take a special kind of person, I think, just in terms of their mindset, to be proactive when you're in the midst of running a business. It's a very, very hard thing to do, to even consider the plan B, right? Because what does that mean? You considering the plan B, does that mean failure? You don't achieve your goal? But it is something that's actually necessary to do.
Yeah, sometimes living to fight another day is a good thing. Sometimes you've got, I've seen, and, we talk to people all the time who have a burn rate that's going to just eat them alive. And so maybe if you can just figure out how to turn off the burn, put the company into some kind of a hibernation mode, it's possible that if you put the company in hibernation mode, that at a later date you can bring it back alive again without having hit the wall or crashed and burned. And then in that case, it may be that you buy yourself enough time to do the research to figure out how to attract the right partners, both talent and capital, to reactivate the company when you actually have a better prospect for success. But if you just keep burning all the cash, hit the wall, that's tends not to be a good strategy. I know the hibernation thing. I don't want to kid you. And my experience, once the company goes into hibernation mode, the probability that it reemerges is not great, but at least it's possible. I mean, I've definitely seen it happen.
But is it better to avoid that hibernation mode altogether?
You can. I mean, well, because part of the problem with the hibernation mode is the people who are necessary that have the knowledge in their heads, they move on. And then maybe the technology gets stale, world just moves on. And although it was valuable and innovative in Q1 2023, if, in 2 years, will it still be valuable? Will it still be innovative? Will the people who actually know how to make it work be willing to come back? Probably not. They will have moved on. So that's why hibernation, it's better than death. But I wouldn't recommend. I would recommend that before you put the company in hibernation, maybe hibernation is plan C.
Right.
You got plan A, which is we're gonna succeed. We're gonna just go out. We're going to get the resources we need to continue to execute our strategy. That's plan A. Plan B, we're open to other alternatives if it turns out they materialize. And plan C is, if all else fails, is there a way to live to fight another day? So the takeaway, I guess, for M&A is this. If you don't run a process where you have more than one bidder, then you are more likely not going to get the best deal. In fact, you might not get any deal. So one buyer is frequently no buyer. It's important that if you are going to try and pursue some kind of an exit through an M&A transaction, that you try to create a bidding war so that the most relevant parties come to the table at or about the same time with their best offer. That's ideal if you're on the sell side.
And the key takeaways for this episode is, remember guys, don't wait until it's too late. Be proactive. You don't want to be in a situation where you've got 6 months runway left and you're desperate to raise money. This is an opportunity for you now to take this information, to be proactive, make your plan B and your plan C while you can. Right, so that wraps up this episode. I want to thank everyone for watching and for listening. Remember to like, to click the notification button, to subscribe, more importantly, and leave some comments. Your comments are important to us. We will read the comments. If the information is good enough, we may even do an episode based on your information. So thank you very much for joining, guys, and we'll see you on the next episode. Take care.